Stocks on pace to snap a 3-week winning streak. Nevertheless, our headline guest today says the market is going significantly higher, possibly even before the election. BlackRock's Rick Rieder joining us now. Rick, welcome back. It's good to see you today.
Hey, Scott. Thanks for having me.
It's a big call. What's behind it?
No, before the election, I think it may not happen. In fact, there's some interesting things in the options market that could keep the market down for a bit of time. But I do think people are underestimating, you've got a good economy with a tremendous amount of stimulus coming in. And I think that will continue to drive the market higher. Plus, you've got a dynamic where the Fed has made much of the fixed income market uninvestable, with treasuries where they are today, with agency mortgages where they are today. When you take the earnings yield of the equity market, the free cash flow yield of the equity market well into the 4% off of next year's earnings, that is a pretty attractive asset class, and I think it'll propel the market higher.
So, election uncertainty doesn't really matter much in the near term. Stimulus talks, negotiations may happen, may not. How does that factor into this forecast? It's a big call that you make. You're the one who suggests in our notes today that it possibly could happen, or at least start before the election.
Yeah, so listen, the election does matter. But if you think about it, and I think what people have started to realize, I think since the last time I was on your show, we've been pretty enthusiastic about markets. What people have to realize is you're going to get more fiscal stimulus in the system. And I think people underestimate, when you put $2 trillion, like we have already had, stimulus in the system, you're talking about almost 10% of GDP. Then when you grow the monetary base, you create a velocity to growth, and you grow the monetary base. It's pretty hard for you not to get nominal GDP that's not significantly higher into next year. So we think we're going to get over 5% nominal GDP next year. So what happens, and there's a big debate about what happens if you get a blue wave, et cetera. I think there's a timing to taxes that is significant. And quite frankly, the system can absorb a bit more debt. The system can absorb more stimulus. And I think that's why you'll propel growth higher into next year. And I think that's why the equity market, the cash flow, you even talk about the earnings numbers. They're impressive. You think about the dynamic that people are operating within today, an unemployment rate as high as it is, you're getting some pretty impressive numbers. Not universally, but generally some pretty good numbers in what is still a tough environment.
Yeah. If there's if you want to call it controversial side to your call today, it's when you look at rates, free cash flow multiples, equities are as cheap as they've ever been. I think a lot of people would take issue with that, Rick.
I think most people would take issue with it. And, you hear all the time, people focus on PE ratio, and PE ratio is a useful metric. But, when we finance real estate, or you finance a receivables pool, and you think about any other form of sophisticated financing, what you think about is your cash flow that comes in and your cash flow relative to the cost to finance it. When companies today have an ability to finance themselves at extraordinarily cheap levels, it allows them to do M&A, it allows them to do CapEx, it allows them to do R&D, and you create what is a really different dynamic. People underestimate the discount rate. People don't underestimate the real estate market, but I think in the equity market they do, and it's part of why I think the equity market is not on the true metrics that you look at and all the right metrics you look at. I don't think the equity market is high at all.
Well, one of the reasons you're balancing that is against where rates are, and saying that low rates, and look, it's a case that a lot of people have made over the last many years. Equities are cheap relative to where interest rates are. You got the backstop of the Fed, et cetera. 84 basis points, though, in the 10-year. I know it's not high. It is higher than where it was. And what happens if rates get closer to 1? Does that sort of upset your thesis at all?
So first of all, companies don't borrow off of treasuries. And I think, there's a big focus on it. And I always think, like, when you hit, I remember your shows for years, when you talk about nodes of the treasury market, they are significant. I think they're more significant from an optics point of view. Companies don't borrow off the 10-year note. They borrow off of where is the high yield market, where is the investment grade market, where's the loan market. And as long as they're being able to finance at these levels, which are incredible. Some companies, the big companies, 5 years in are able to finance at 50 basis points. That is incredible. You can buy your stock back. You think about weighted average cost of capital for a company. If you can finance at levels like that, if we move up 15, 20 basis points, 40 basis points, and listen, I think I think the back end of the yield curve will probably elevate over the next few months. I mean, part of it because I think economic growth is good, and the Treasury has to issue a tremendous amount of debt. But boy, if you take, the markets will focus on it if rates move up significantly, but I think they're not going to move up that dramatically to affect the equity market.